All right, let's get practicing in QuickBooks Online. Grab the link below in the description so that you can follow along. All right, here we are in the QBO gym. And the QBO gym is a place where we have numerous exercises that simulate real life scenarios that you may encounter as a bookkeeper. Every single month, we come out with new exercises for you to practice and complete, and we break it down for you into 4 different sections. So today we are going to be working in the November cardio section. At the top here is a little animated video giving you a little synopsis of what's going on in Craig's world that month. He is our fictitious business owner. Further down is an interactive quiz to test your knowledge as it relates to the video up above. And then further down are all of the exercises within this section. So today we're going to practice correcting the loan. You will need to be in the sample company. If you're not sure how to get into the sample company or get your own free QBOA account, go ahead and click on the link below in the description. So our scenario today is that Craig took out a $25,000 loan from the bank. His previous bookkeeper supposedly already entered it in QBO, but he's not seeing it. So let's see what's going on with the loan. First, we need to go into the chart of accounts. So to do that, we're going to click on Accountant Tools and then select Chart of Accounts. So here I am in the sample company. This is the dashboard. At the top here is Accountant Tools. Go ahead and click on that and then select Chart of Accounts. If it's your first time using the chart of accounts in the sample company, you may have to click on something that says see your chart of accounts. It happens sometimes, but if not, if you get a screen that looks just like this, you can go ahead and move on to step 3. So if we're scrolling through the list, we can see that there is a notes payable account set up for $25,000. Let's go ahead and scroll down until we find that. It is, oh, I just passed it. There it is. Notes payable for $25,000. This seems kind of strange because the term notes payable is typically used to refer to the transaction on the bank side. The recipient usually refers to it as just a loan, but it is also set up as a long-term liability, so at least that much is correct. So let's see what else is going on. And long-term liability versus short-term, typically you would categorize something as you would make an account for short-term if it's less than a year, going to pay it off in less than a year. Anything more than that usually is considered a long-term liability. So anyways, let's keep going and see what's going on with this one. We're going to click on View Register on that line. So here's notes payable. Click on the View Register. If you get any pop-ups, just go ahead and click out of those. It looks like there is just one journal entry here, and it says opening balance for $25,000. So let's take a little bit closer look at the journal entry. Go ahead and click on Split, and then we're going to click on Edit. So click on Split right here. This opens it up a little bit more. Go ahead and click on Edit so that we can get a full look at the journal entry and all of the details. So the first part of the journal entry is correct. It credits the notes payable account, meaning it increases the amount of liability, which is good because a loan is a liability. The second part, however, is not correct. It's put as an opening equity or opening balance equity, which is only to be used when you or QBO does not know precisely where the money went. This is typically seen, for example, when you're converting from another accounting system. In that situation, you may not convert all the details of every single transaction in QBO because they have already been recorded in an old system. So that may be a reason why you would use the opening balance equity. But that is not the case with Craig right here. Craig had deposited it into his checking account, so the only adjustment we need to make here is changing the account. So in the account field on the second line, we're going to change it from opening balance equity to checking. So click into it, and you can click on the arrow right here. It should be all the way at the top. Yes, there it is. Go ahead and click on checking. And then we want to make a little note here in the memo field as to why we are making this change. So we can say down here, it says, change the debit account to accurately reflect the deposit. So let's go ahead and put that in the memo. Change the debit to accurately, what did I say? Change the debit account to accurately reflect the deposit. accurately reflect the deposit. Debit account. There we go. Change the debit account to accurately reflect the deposit, which is what we want. And then we are going to click on Save and Close. So let's go ahead and do that. Click on the little arrow down here, and then you can click on Save and Close. And it's giving you this little pop-up warning from QBO. And the reason they are doing that is because you are changing the transaction that has already been reconciled. Opening balance transactions are always automatically marked as reconciled. However, since you have not actually reconciled the opening balance equity account, this is not going to affect you. You will eventually have to reconcile the deposit in the checking account, but that's not what this message is referring to. So go ahead and just click on the green yes button for now. And that has now been saved and changed for us. So final thoughts here. This situation is a little bit far-fetched. Craig could not understand why the money was not showing up in his QBO checking account. Since he had deposited the money, it would have shown up in the bank fee transactions, and in real life scenario, he or the bookkeeper would have noticed this. So they would not have been able to reconcile the checking account if they were not able to track it down. The real purpose of this exercise was to demonstrate how an incorrect journal entry could cause problems and how to go about fixing it, as well as to highlight the incorrect use of the opening balance equity account. Once the loan is set up, a next good step would be to set up a recurring transaction to record the principal and interest payments each month. Now that you've spent a good deal of time practicing recurring transactions this month, you may be able to do that on your own, but that is outside of the scope of this exercise. But that's it. That's how you would make an adjustment on a journal entry, whether it was for a loan or anything else that needed a little bit of adjustments. And if you have any questions or want to know more about the QBO Gym, just go ahead and click on the link below in the description. We have one more exercise here in the cardio section where we focus on paying the bills. And I will see you in the next video.